a sign of growing optimism that markets could go still higher after soaring first half. Can they? Let's get the read right now from Luke Lloyd, the Strategic Wealth Partners investment strategist. We've also got Michelle Schneider, the Market Group Managing Director. Last but not least, Mike Murphy, the Rosecliff Managing Partner. So Mike, begin with you on how the second half is looking for you. Can you hear us, Mike?
Yes, I got you, Neil. You broke up there. Can you just repeat that? Sorry.
Yes. Are you worried that the market will crash? No, I'm not saying that. My focus is how does the second half look to you?
I think the second half, Neil, is going to be a repeat of the first half. Maybe we don't get 15% on the S&P, but the setup right now is for earnings to continue to rise. And if we have strong earnings, that should equate to strong stock prices. So there's a lot of concern out there, whether it be inflation, whether it be rates, whether it be the Fed, whether it be the Biden administration. So many concerns out there for people. But if you focus on what's been working, if you focus on the growth areas, I think you're going to get a very strong second half of the year, somewhere in the 8 to 12% return on the S&P.
Wow. Michelle, I know markets climb a wall of worry, and we've thrown a lot of worries at them, but yet here we are with stocks advancing and interest rates holding. In fact, we're well under 1.5% on a 10-year note. So what's going on?
To pick up a little bit on what Mike said, it's certainly right now we have the momentum in the favor of stocks continuing to go up. But there are some warning signs there based on some of those concerns, which is why the wall of worry is so apropos. Like, for example, yes, we have the S&P going up and we have the NASDAQ going up, but the Russell 2000, although going up, still hasn't gotten as high as it was in March when it got to 234. The transportation sector actually has come down a lot. That's certainly showing some stress. The financials, especially in the regional banks, showing some stress. And even though the semiconductors have gone also rocketing here, they've come off a little bit too. And we're seeing this sort of divide in the market, which has to reconcile. Of course, it can reconcile in several ways. It could either be that these industrial transportation sectors are looking for some more hope for the growth of the labor market beyond this back to work once the unemployment benefits go away in September. Or it could be that they're sending an early warning with the growth going up. We've seen this before. It goes up, up, up. The rest of the market sits. And then all of a sudden, NASDAQ and the growth stocks look around and go, whoa, and then they start coming off. We don't know that yet because there's too many varying signals here, with junk bonds good, but coming down a little, yields holding, but very vulnerable, and that inflation narrative, which right now is sitting there on the table, sort of the elephant in the room.
Luke, last time you were here, you were talking about what worries you when the government gets involved to sort of prompt things up. I think we were talking at the time about the Federal Reserve, and of course you could extend that to Washington, all this, spending. So I guess I'm going to flip it around. What if all that stops? The markets have risen through all of that, maybe welcoming it because stimulus is stimulus. What happens if that's it? This infrastructure deal is about it. The best hope the administration has to get anything done in a big spending way this whole year. That might be it, and maybe that might not happen. How would the markets react?
Yeah, no, I think they are welcoming that right now because the influx of money from the federal government right now for the spending, I mean, that's a good thing for the markets in the short term. The problem is in the long term, it's not a good thing. So at the beginning of this year, I talked about how there will be two drivers for 2021, the federal government and the Federal Reserve. Well, so far, it's been true. All eyes are on what the current administration is going to do in regards to tax policy and spending. All eyes are on the Federal Reserve of how they will react to the inflation. Thankfully, in regards to the government, Joe Manchin has more power than Joe Biden right now and is keeping these extreme policies in check. But in regards to the Fed, I still believe the Fed is underestimating the impact of inflation. So the question is which asset classes will perform the best if they hike interest rates too soon? Gold, stocks, Bitcoin, bonds, real estate, all of these asset classes will have a knee-jerk reaction to the higher interest rates. But after the reaction, stocks and real estate tend to perform the best. I don't think that's any different this time around.
Mike, a lot of people have been looking at real estate as well. Home prices have been soaring. Demand for homes is beefing up considerably. And that's generally a constructive environment for stocks as well. Do you see that continuing?
I do, Neil. And you look, we need to build more new homes in this country. And so, there's demand for new homes, and there's also a demand for existing homes in the right areas. So I think people are willing to pay up. And then even more so, the trickle-down effect to that, Neil, is as people have their homes or their new homes, they're spending money to refurbish their home and improve their home. So I think right now real estate is in a sweet spot because we talked, you and I spoke about this a few years ago, that maybe we're just going to be a rental country going forward. The millennials may never want to buy, and that's now been proven wrong. The millennials, the younger generation, do want to buy. So there's a long way to go until all of these people have homes. So you're going to see a demand for housing. That's going to continue, provided remember, Neil, this is all predicated on the fact the economy stays strong. If that changes, then we have to relook at this. But right now, strong economy, strong housing, and I think that has a long way to go.
There's the other issue, though, that could dampen this strong economy, and that is finding workers to keep it going. We're going to develop a problem. We're going to get into that in a second in the show. Does it give you pause?
Well, yes, I think you just touched, Neil, on exactly what my biggest concern is the labor market. One is where are new jobs going to come from once we get back to work and everything's reopened. And number two is it's already adding to the inflationary environment because, for example, one of the reasons why, not the only reason, but one of the reasons why gas prices are so high is they can't find truck drivers to deliver the gas to the stations. And so this labor issue is not only not great for the economy in general, but it fuels those fires of inflation. And as far as inflation goes, people are calling this inflation. People who have not been around for as long as I have, for example, don't really know what inflation looks like yet. And I think that's what we're seeing coming potentially as we go into the end of this year and next year.
Don't get me started on the young and the restless not knowing, because I'll start sharing what my wife and I first paid on a mortgage when it was in the mid-teens, and we thought we were brilliant.
I don't want to hear
Luke, no, I know. I can't blame it. I don't want to hear it. My wife doesn't want to hear it. Luke, are you worried about inflation?
Yeah, absolutely. I think the Federal Reserve right now is absolutely underestimating inflation. But the thing is, when interest rates rise, gold, commodities, and stocks tend to sell off. This is going to sound kind of crazy since very few people talk about it, but the best inflation hedge after the knee-jerk reaction for higher interest rates, like I mentioned, is stocks and real estate, but specifically, it's actually technology stocks. If you look to the past, tech stocks perform the best in high inflationary environments. Well, why is that? It's because during periods of high inflation, input costs rising is one of the major drivers of inflation. Which sector is the most asset light? Technology is. Think about software. There's nothing physical to it, so many tech stocks have pricing power and high margins, which allows them to be flexible and weather the storm during periods of high inflation. So in regards to the stock market and those that can allocate capital, I'm not that worried, but for the middle class and those that don't own stocks and real assets, it's really going to hurt the pocket, and that's where you're going to see the pain.
All right, Luke, final word on that. Michelle, thank you. Mike, thank you very much. Sorry for the audio problems there, Mike. In the meantime, we were talking about labor pressure.